Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to Zacks Top Stock Picks of the Week. I'm Tracy Reineck, and this week I'm joined by Zacks Director of Research, Shiraz Mian, with two Zacks number one ranked stocks. One's a value, one is a growth stock, but which may also now have value given the sell-off in the growth stocks here in 2022. But I'm going to kick it off with the value stock. It's a pure play classic value stock based on forward PE, and it's AutoNation, ticker AN. And as we all know, we're all buying cars, right? We started buying during the start of the pandemic. It basically picked up steam last year in 2021, but the analysts thought that the story would be over. I mean, how many cars do people need, right? But no, 2022 has started off just as strong, and prices on both new and used cars remain elevated. So that's been pushing up the earnings and revenue for this auto retailer. So let's dive right in and look and see what's going on with the estimates. What did the analysts get wrong? And what are they doing to compensate here in 2022 with those earnings estimates? So this is the detailed estimates page on Zacks.com for AutoNation. And you can see the key category I always look at is this current year and then the estimate revisions. And you can see that over the last 30 days, 6 estimates have been revised higher for this year, 2 for next year, but we're not so concerned with next year quite yet because we're at the beginning of 2022 still. We're in the first quarter. So I'm more interested to know what do they think is happening this year? And they've gotten much more bullish. So AutoNation reported earnings in February. It was better than expected. Demand is still strong. Both new and used auto revenues were up in that quarter. And so the analysts all revising here. A year ago, they made 1814. Analysts now expect 2006 here. And you can see if I scroll down a bit, the big revisions here, these are the 6 estimates here, because the analysts were being just more conservative heading into that fourth quarter earnings report, and then some guidance on what was the outlook looking like for 2022. They realized they're too bearish and they have to raise. Now you can also see in 2023, they were still too bearish looking even further down the line, and a couple have raised here, pushing up 2023. But again, we're not that concerned with what's happening in 2023. If you move up here, they're showing a decline again on the earnings because the analysts are still asking, how long can this keep going? How long can the car sales be this good? But for now, here in 2022, once again, they are going to be good. And some of that has to do with the fact that the job market is strong. So with the strong job market, what do we buy? We buy a lot of consumer goods, and we will buy autos on a strong job market and strong economy. So despite the rise in prices for both new and used cars, consumers are still going out there and buying, getting that new car, that new auto. Let's look and see what this looks like on the chart. So this is one of my favorite charts, the price and consensus chart. And you can see that they are showing it just as bullish on this chart because not much was happening here before the pandemic hit. And then we had the downturn, and then it's been off to the races ever since. And you can see this top blue line is the 2022. So that's more bullish right now than 2023. But I'm looking for 2023 to correct itself and figure itself out as we get to the second half of the year. And also, I like to bring this chart. This is the earnings surprise. AutoNation has a very good earnings surprise track record, although you can see it is getting a little more dubious for them to beat, even though this was a 15% beat for the last quarter for fourth quarter. But the shares have pulled back a bit here. That's why I like to look at this chart to kind of see what's happening with the share direction. And they've had the big rally off of 2020 lows over the last 2 years, up 350% on these shares, but has pulled back a bit, and over the last year, up only 32%. Year to date, we're up a little bit, which is better than the S&P 500, up 1.7%, and the S&P now is up about 6% since we've had a little mini rally here. But these shares trying to get back up to 130. Now, does that mean you shouldn't be buying here at the 5-year high or near the 5-year high? Well, the shares are only trading at 5.9 times that forward earnings with a peg of just 0.3. Both indicate strong value plus the growth. So it's got that going for it. They don't pay a dividend, but they've been doing huge share buyback over the last year with all that free cash flow. And they've bought back millions of shares here, and they're doing another 1.1 billion, or well, 1 billion share buyback for 2022 that they announced in February, but they've got 1.1 billion left on that share buyback. So that's why when these shares sold up a bit, why wouldn't the company be buying them back? So I'm assuming that they are. So it's got a little bit of a floor underneath it with that big share buyback. It's cheap share buybacks, and things are still looking good on the auto side. So I really like these auto retailers here still in 2022. If you can get them on any kind of weakness, like some people did here earlier in 2022, even better. But I think AutoNation is going to surprise some folks as we head into the middle of this year, because the job market is still good and the demand for autos is still strong. So that's my Zacks #1 rank, strong by AutoNation. And I'm going to turn it over to Shiraz. He's bringing you the growth stock, which may also have some value. So I'm handing it off to Shiraz to dig in on what dream stock that is.
Thanks, Tracy. My stock is DocuSign, one of those COVID darlings that have really fallen on hard times. There are good reasons for why DocuSign, its value, the stock price is a third of what it was in the not too distant past. Currently trading around mid 90s, I want to say, was as high as 300 in its heyday. The last 2 quarterly reports, just to put it nicely, were atrocious. The latest was on March 10th. They beat estimates, but the guidance was poor. You could say something similar happened in the one prior to that. The latest quarter saw the stock drop more than 20%, almost 25%. The one prior to that had the stock drop almost 40% on the release. So really the air has come out of the DocuSign story. A lot of that has to do with the macro story. The market and broad sentiment has soured on growth stories. Nobody wants to hear about TAM, total market opportunity, total addressable market anymore. And that has to do with how mood sours on companies whose profitability is way out in the future during times when the Fed is raising rates and there is other uncertainty. And as we all know, there's no shortage of uncertainty. And the Fed has started raising rates. And then, as I mentioned, there are fundamental reasons why the mood should sour on DocuSign. Full disclosure, I had this stock as a Zacks top 10 stock, which is our annual buy and hold portfolio of 10 stocks for calendar years for 2020. And as you could imagine, it was a home run for us. I still own the stock in the Zacks focus list portfolio. When I look at the stock and look at its current valuation and look at where the stock is trading currently, it's not that far from where it was when I picked it for the top 10 2020 portfolio. It's around mid 90s now. At that time, it was in the mid 70s. But the business has moved a lot. They have added literally tens of thousands of new customers. Turnover in the business is very, very low, so those relationships are sticky. And DocuSign, its product and its different offerings are essentially synonymous with the e-signature in the automation team and process as a whole. So we know whatever growth is out there in this space, DocuSign will be a big beneficiary of it. So there's headwinds. There's undoubtedly questions about the company's near-term growth trajectory. Demand was pulled forward during COVID, and we are seeing the effect of that in 2022. But it is a profitable company. It'll be bringing in a little over $2 billion in revenues this year, around $2.4 billion next year, and then $2.8 billion the year after that. The product, the offering, the service is viable and credible, has a long-term secular growth trajectory. Valuation has really come down to earth. It's currently trading on an enterprise value to forward 12-month sales basis at around 8. The median during its public life has been more than twice that level, and it has traded as high as 30. So valuation is reasonable. If you have the patience, if you have the ability to wait for the stock to come around and show the resilience of its product and market opportunity, I think you will be richly rewarded, perhaps not as much as our top 10 subscribers were in 2020, but this is definitely a stock that's worth, in the long run, more than $200. So this is a long-term pick. This is not a near-term tactical trading opportunity. I believe the stock will remain range-bound around where it is. Over the next few quarters, the market needs to see that the repositioning in the sales effort, which over the last 2 years was essentially a demand fulfillment, to going forward being demand creation, is the management team is able to execute on that. In the latest quarter, when they announced the guidance disappointment and also announced share buybacks, they shared a plan for sales restructuring. So the market will be looking for execution on that sales restructuring, and as the company shows results on that, I would expect the stock to remain range bound. But beyond the next 6 to 9 months, beyond the next 2 to 3 quarters, I see much better days ahead for the company. This is not one of those fancy, glamorous names that became attractive during COVID and is no longer as attractive. This is a leading product in a space that's growing, genuinely growing, and I see for those who can buy the stock now and wait for it at a minimum a year, preferably 2 years, getting richly rewarded. That's it. This was my top stock pick for this week.